I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Thank you, Jim.
Danielle, do you think the U.S. Fed is going to continue hiking interest rates, or are they on a permanent pause mode right now?
It seems like they are on a pause mode of some duration, and I think it's likely to be a perpetual pause. There's some talk of whether or not they may just take a break and see how the data comes in the next couple of quarters, which is what they like to say, right? They like to say they're data dependent, but the reality is that the global economy has shocked them to the downside, shocked most people that were, living in fairy tale land, I think, in my opinion, but just looking at, the expectation for a never-ending cycle, I guess, is what some people do. And, so they were thinking that they would be able to continue to hike rates further and that the economy would continue to expand and all would be well. But of course, when you have a world that has never been on the zero bound before, and we've spent many years now at these emergency low rates where people were able to, global debt was able to double in the last decade, you really don't have a test case for this kind of environment. And it shouldn't be surprising to anyone that trying to move off the zero bound when everyone's doubled their debt is a very dangerous thing for the overall economy. So the downturn is baked in already by the fiscal policies and monetary policies, debt that's been used to extend it. When they began in 2010 with the quantitative easing and all the various ways that they tried to goose the system. And so it's really baked in now. So I think that, what everyone has to keep in mind, and there's much hope that if they were to start cutting rates again, that things would suddenly rally in terms of global growth and everything would turn itself around and, Germany and Italy would not topple into recession and somehow China's debt, which is just mind-boggling above 300% of GDP today, that somehow all those things would be miraculously fixed if we could just get another cut out of the Fed. Of course, the fact is that that's not going to fix that. And even if they did move to cuts tomorrow, Jim, that takes a matter of several quarters before it would even filter through from the banking system into the real economy. So that, as we've mentioned before, the hikes they began from December 15 to December 18, only a small portion of that has already worked into the real economy, and we've already seen this dramatic deceleration in demand and growth, the Baltic Dry Index, global trade. And this is not all about, things like Brexit and things like China and the U.S. and their trade negotiations. That's all classic sort of reasons or rationales that people come to late in the cycle when things begin to turn down, and they look at these sort of poster children for why this may be happening, and they peg it on things like whether the U.S. government is going to get because it shut down for a couple of months there, and now there's a big rally today on hopes that they're coming to some kind of a deal to keep the government going and get by the wall impasse. All these things are just sideshows. As I say, the economic cycle was extended by years of extraordinarily loose monetary policy. And in that period, we could have used low rates to pay down debt and build up savings, but in fact, we did the opposite. And because the world did the opposite, it now has to pay the price. And there's nothing really that central banks can do if they even go back to trying to buy more assets. Right now they're trying to taper the amount of assets they hold on their balance sheet. Even if they go back to trying buying more, the fix is already in, I'm afraid, with the debt. And that the only way to clear this now is for a massive change in consumption pattern, which will go back to saving of necessity, that will write down debt of necessity because bad loans have been made, and will force people to build up their savings again. And only that is how we get more sustainable and stable economy in the future. That, along with some pretty significant changes in policy, are needed with regard to corporate policy. The buyback craziness that's gone on, that has to end. All of that, again, has left companies more vulnerable going into this downturn. Again, back to if they'd used low rates to pay down debt and build up their savings, their retained earnings and that sort of thing, it would have been sort of fuel to get them through the slowdown. But corporations did the opposite. They spent something like 90% of all their income in the last several years on buying back shares, and they borrowed a whole bunch of money to do that. So as share prices fall, the debt stays the same, and it was just a complete waste of money. And so it leaves them very ill prepared now for a slowing period.
Well, at one time, buying back your own shares was illegal. Why did they change that law?
Oh, because the lobby, basically the corporate lobby, wanted to be able to have more impact. Bill Clinton had a bill that was, again, signed to limit the amount of income that CEOs could be paid. And to get around that, they decided to move to a payment system they loosened the amount that people could receive in equity as opposed to in salary. And so what happened is once people were fixated on compensating the C-suite in shares, they then said, hey, we have to figure out ways to get the share price up because everyone's very focused on, short term, how do we get the share prices to go higher? So what happened was they then loosened off the restriction which had long been in place that decided that buying back shares was a manipulation of price and an illegal manipulation, as it should be. But indeed, because they wanted to ratchet up CEO income, they went, loosened those policies, and that became the mainstream preoccupation. And indeed, it's worked fantastically well for CEO pay. There's no question. In my lifetime, CEO pay has gone from 20 times the average worker to now 300 times the average worker in terms of a ratio to income. And much of that has come from, as I say, the equity compensation. So we've really run to the end of that very destructive trend as well. And there's some legislation been proposed to control or eliminate buybacks, go back to penalizing them as illegal market manipulation. I think that's all very constructive. I think in the new paradigms, what we're going to have to do is focus people on repairing balance sheets. So while all the incentives have been on how do we goose consumption, how do we force people to borrow more money and, save less, that's really been the modus operandi of policymakers, of corporations, of politicians. That's been the go-to plan for the last 30 years. And now that we're so toxic with overconsumption and undersaving and too much risk in the system, too much bad debt in the system, now I think that the focus will have to shift to how do we compensate people or focus their attention on not how do we goose equity prices, but how do we, bring debt ratios down? How do we, part of that is possibly to change CEO compensation with a metric link to the balance sheet, to debt level, perhaps compensating them in bonds of the company rather than in shares of the company. Because if you're getting compensated in bonds of the company, Jim, guess what? You care whether the company pays you back. So all of a sudden your entire mindset comes away from this short-term gimmicks to goose price at all costs to how do we maintain the strength and stability of the company over time. So I think those are all sort of where we're headed. Getting from here to there is likely to be extremely volatile, not just in political circles and upheavals, social unrest, but also just in terms of the market pricing that we've got currently for things like equity prices, which, as we've entered into, there was a question from one of the listeners last week, or the last time I was on, asking how corporate earnings have been able to rise through this period, even as, global demand has weakened, and why were they in such a robust up period for so long? And the main answer, the largest part of the answer, is that the buyback was what has really sustained it, along with speculative fervor. So people were induced by central bank policy and incentives to sort of, throw caution to the wind and safe places like, treasuries, guaranteed deposits, savings deposits at the bank. Because rates were so low, they were incented to toss all that aside and go risk-seeking and try and find things that were, paying you more, at the great risk to the capital, of course. And so all the incentives really were, as I said, about how to get but in buying back shares, you artificially inflate the earnings per share, and then you report higher earnings growth. That on top of things like underpaying the workers, so that, we've had this huge downtrend in union representation and bargaining power and, offshoring of jobs. All these things have made the cost of labor so cheap relative to the other cost structures and relative to revenue, and that helped as well. But the primary thing has been the financial manipulation that has gone on. And the amazing thing, not so amazing if you understand the cycle of this thing, but we saw a very similar trend, for example, in 2000 and 2008, the peak of those cycles, where corporations have been doing all these financial gimmicks to stimulate price. And then what happens, of course, is that the earnings trends finally start to falter, because global downturn means your revenues start cavitating. And that means that your price to earnings ratio, so the price of your share relative to your earnings, starts to really go negative. And then you have, when earnings decline, the multiple you've paid is revealed to be that much more garish. And so then people start to realize they've overpaid and begin to sell. And that's indeed what we're seeing. That's what we saw in the fourth quarter of 2018. And I think, now we're seeing the S&P earnings are likely to decline in the first quarter of 2019. And the forecasts have all come down, Jim, in the past few months, so that the total year earnings for 19 are now expected to be negative relative to decline relative to 2018. So that's essentially an earnings recession. And we saw that at the turn in other cycles as well. So once you get an earnings recession, it's a good indicator of economic recession as well.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
Welcome back. We're speaking with Danielle Park. Danielle, of course, now people are calling for a public investigation or hearing into money laundering in BC, where there's video of obvious sacks of money being poured out at casinos and no questions being asked about it, houses being bought for cash. And one of the reasons why BC's real estate skyrocketed in 2016. It's coming down now, but nobody can afford even to buy at these prices. How is that seen across Canada? Money laundering everywhere, and the conviction rate for it very low.
Well, this goes back to incentives, Jim. So, the people are reaping commissions and payments based on higher asset prices. They have every incentive in the world to try and keep asset prices going up, right? The problem is that it's very destructive for the rest of the economy. So all the gatekeepers, like in the banks, the lenders, the realtors, mortgage brokers, all the lawyers, the people that were supposed to be, being, we do have a fairly extensive money laundering code, rules in Canada that should prevent people from being able to just produce bags of money. But because there's so many people that see it as, easy street, or, they're on the receiving end of benefits as the cash floods in, they just don't enforce the policies of the land, or they turn a blind eye, or they, help people get around, the rule set. And that's what we saw, that W5 expose is quite amazing for the film footage, but we've seen evidence of this for a long time. Whether it's not, and it's certainly not just in Vancouver. I mean, you had the problem of the casino being a major portal for, illegal proceeds of crime, whether it's drugs or other things, and people bringing it into the casino as a way of laundering it and getting it released into released to them into the banking system. That's ultimately the goal. But also land banking, so just bringing money in from abroad and getting it into the real estate market as a land bank. And of course, the impact of that is not just insanely valued housing, which becomes a major social destabilizer because the average person can't afford to live in the place they grew up, or they can't afford to own a home because prices have become so ludicrous, because rents become so ludicrous, because the prices are so high. But also, everyone forgets the other side of that. Even the people who are, reaching to acquire homes in that environment or buy luxury retail, luxury automobiles, this sort of thing, they are doing it with massive amounts of debt. So the average person who's not bringing in illegal funds or not money laundering, but is just trying to keep up with the trends and, keep buying these things alongside these illegal flows, are having to massively increase their debt in order to do it. So the overall economy suffers greatly because of the lack of savings that can be, because people are servicing so much debt. There's so much friction and waste going on in the cash flow that there's not enough funds for the things that matter a great deal. And also you're getting, increased crime, the lure of easy money, people that would maybe have normally followed the rules, start seeing everybody else doing it and thinking, why am I being so cautious when everyone else is, making off like bandits? And then, of course, the last piece of that is massive loss of government revenues. Things that we, should be taxable, whether it's when they're coming into the country, it's when they're in legitimate pursuit. Things that we should be collecting tax on, we're not, as they move into these, dark pools, so to speak. And all of that costs us a great deal. So we Canadians are paying the price today and will for the next several years because of the weight, these really reckless policies and behaviors which have been allowed to run rampant. So there's no free lunch. We're all going to have to pay in the slow growth period where the capital flows retreat again. The people that took on too much debt have to, write it off, go bankrupt, and that's happening a lot. There's a big spike now in filing for bankruptcy. The trustees and bankruptcies are reporting a very boom period for their business. But for everyone else, it's a very negative experience.
Well, the only people in BC right now not calling for an inquiry into money laundering is the Liberal cabinet or shadow cabinet, because their government was in power during the time all of this was happening. And it was the BC Liberals who dismantled the police squad that was supposed to investigate money laundering in casinos.
Well, this is exactly what we find, and it's been a trend worldwide in, say, the last 20 years in particular, where corporations and the easy money folks get so wealthy and so able to lobby the government that they infiltrate it both on the regulatory side and the policy side, and they start queering everything in their favor. And then you have, everyone complicit sort of in the continuation of this very destructive model. And then the people that are in the places of power try and resist the investigation. because they don't want it to be revealed that it was on their watch, or that, even if they were not, on the front line of taking money, so to speak, they're very often they've received incentives of other kinds, or, they just don't want it to be revealed that this happened under their rule or under their watch. So yeah, you really have to, what you have to do is fund, and this is the other horrible thing that happens, is that the government, essentially in these periods begin to cut funding to regulators and police forces and, the crown attorneys and the people who are supposed to not only, who are supposed to prosecute but also investigate and be the watchful eyes, start to receive less funds in these periods typically, because people think, well, they're just a pain anyway. Why do we want to have more of the oversight when we're all doing so well and this is all going so swimmingly? Of course, that's classic. So we're going to have again, a public demand for investigation, for transparency, for revealing exactly what went on, and for stopping the gaps, for changing the rules where necessary, and for demanding a much stepped up enforcement program.
We'll have more with Danielle Park right after this.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, we all see the ads on television from the banks saying, come on in for some great financial advice. Are people getting great financial advice from the banks?
Mm-hmm. No, they're getting sales pitches, which is fine in and of itself. If you go to buy a product and you ask someone who is paid to sell you the product for their recommendations, as long as you're aware that you're dealing with someone selling those products and they are therefore going to recommend as best they can from the products they are selling, that's a different dynamic entirely. What the banks do, and this is again something, Jim, that we had stopped in past, in the 30s, we brought in a bunch of rules after the banking collapse in the 29 cycle, where you couldn't be a product producer and also, quote unquote, advise people. And of course, since the 80s, the amalgamation that went on in the industry, the banks bought the broker dealers, bought the insurance companies, bought all the mom and pop investment counsel shops, which were independent in the early days, all kind of got rolled in to the conglomerate, so to speak. And so what's happened is, again, back to the concentration of power and wealth, the government continued to clear the rules, made it so that it was easier and easier for them to cross-sell, to grab, quote, share of wallet, which is what they love to call the customers. They see, how do we get more of their share of wallet? And even things like, the credit score scenario. Again, there was the clip I put on the blog about how the whole credit score fiasco, when you and I were growing up, people didn't even talk about credit scores, Jim. But in the 2006 collapse in the States, in the early 2000s, you heard a great deal about credit scores in the United States, as ironically, as their credit was deteriorating, as people were becoming more indebted, had less savings, the focus shifted to, how do I game my credit score? How do I, and why? Because credit score is something the banks give you as a number to suggest that you're worthy of more lending, right? And so it's really nothing to do with your financial health, as Scott Theriault explained in the clip I put on the blog on BNN. He was talking about the reality is that if you haven't borrowed money, if you have a large amount of savings and you don't owe money, you could have a weak credit score in this backward system. because the banks want you to be someone who consumes their products. So it's not, this is again part and parcel of how Canada's the mess we have. It is because people typically go to their banks or their broker dealers for quote unquote advice. And that advice very often is, hey, you can borrow, we can give you this loan for whatever you want in terms of present consumption, and even, God forbid, to buy financial products as an investment loan, which is usually a totally horrendous thing for people to do. But it's all about how do we get the customer to sign up for more of our product, more profit center for the bank. So it's not surprising now that we have banks that are extremely well off, and we have everybody else that's busted, poor. And, as much as Scotiabank likes to insist that we're all richer than we think, actually we're all poorer than we think in many ways, thanks to this concentration of marketing and sales. So yes, we need again to divide this back up and say, if you're going to be a product seller, you can't be calling your staff advisors. You can't be, getting people into your products and assuring them it's in their best interest when in fact you're a sales franchise and you don't have to put the person's best interest first. So it's a lot of the incentives in the system, but it's also the individuals. People love to hear that they can have things without saving for them. It's a very or attractive proposition, I guess. So people have to go back to wanting to deny present consumption in the interest of developing future strength and stability in the form of savings. And as they get their savings, they have to be very protective of the capital rather than always looking for what's going to get them a quick buck in, expensive financial products. So we really just have to turn the whole thinking and behaviors around. And I think, it's going to happen. And the reason I feel confident is because it has always happened in past cycles in human history. This is a very common theme, but also because as financial assets deflate, and I believe that the downturn that began from in the third quarter of 2018 is this long overdue, busting of all these crazy forces that have elevated asset prices far beyond the realm of the real or irrational. And it began, we've had this sort of rebound rally in the last few weeks, but I think that, as I say, the underlying facts being the state of the debt, the extension of the cycle, and the fact that central banks are now out of options and have very little room to cut time to re-stimulate. I think all those things are bringing us to the point where we're at a major turning point in the economy. And that'll actually, as I say, it'll be painful for those currently extended with too much debt holding assets that are going to come down in value. It's going to be painful in the sense of I think we're due for an economic contraction or downturn. That means people will probably lose jobs. But it'll be ultimately positive in the sense that it'll break up very destructive thought patterns and thinking that's prevailed in the last 20 years and give us a cleaning out period, which is desperately needed. And it'll be healthy in the sense that once asset prices come down, whether it's, security prices like equities and corporate debt, whether it's real estate, whether it's the inventory of all these incredible inventory of cars sitting pumped out now, where people, without buyers, just sitting waiting, because they overproduced at the top of the credit cycle. All these things will ultimately bring better value, better pricing, and affordability back into the picture. And that'll be very positive.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet, our YouTube channel, Talk Digital Network. If you have questions for Danielle or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.